Today we're going to have some lineup for you in terms of the technical outlook. And we're focusing on this time because we've just seen a change in the market that we think may prove to be quite serious. And we'd like to see how much more of this could likely develop along the way. And we should be able to be prepared for what is to happen, or hopefully, if it can be overturned, then we all have to be ready to be able to act into this particular cause. So let's get right into the presentation. Now, when we try to be able to analyze what's going on to the market, you have to understand that the technical outlook here is very representative of what's going on in society, or it could be what the market is trying to be able to factor a little bit in advance. And of course, the market is quite reacting to whatever news that it's attempting to be able to pull out from what we're seeing into the Philippine context as well as the global context. And of course, given that particular consideration, we're going to have to see what is happening around the world. And then, of course, we'll localize the view into the Philippines so that we can best try to see whether there could be any either headwinds or tailwinds coming from either an external markets, or perhaps it could be something happening on the internal front. So we'll start off first by trying to be able to look into how markets in general have actually been faring. Now, if you were to look at the graph that I have here on the left side, it shows you how certain other markets have actually performing as compared to the Philippine index. And if you can see very clearly that the Morgan Stanley Emerging Market Fund, the S&P 500, the MS World Index, which is a much broader indicator, and of course the Chinese market, all have so far been registering advances since the beginning of this year, and their indices seem to still be doing okay. And of course, China being maybe the one almost a little bit more neutral. But I think as a standout, you can see that the Philippine index has been quite depressed, as we were down about 8% so far in that condition. Now you might ask, what's going on? And are we the only country that's doing this, or could there be other Asian markets that are feeling the same type of pressure? If you look at the chart I have here on the right side, I put the Philippine index in the middle of different types of Asian markets. And if you clearly see one particular point here is that this red arrow that you see, we are the only index in Asia that has managed to be able to break below the 200-day exponential moving average. And clearly that is the concern that we are attempting to be able to deal with today. If you look at the others from Japan, China, Hong Kong, Thailand, Malaysia, Indonesia, India, and Singapore, none of them have managed to be able to do that same feat as of yet. So clearly something's happening into the Philippines that the others don't seem to be jiving with. And it's because of that we need to be able to adjust what is it, and do we think that it'll probably continue or not? And that's what we're going to have to be able to look into later. Now, going back into, of course, the broader market first outside, and we look at the US market, because if the US market happens to be able to go into another corrective period, that too could add itself as added pressure into our market moving forward. However, looking into the US market, I have the S&P 500 here on the left side, and I have the NASDAQ here on the right side. The NASDAQ is the one that seems to be the weaker index in recent days. And I think the NASDAQ may have to be able to play out a sideways shift, maybe between 12,500 and maybe the highs closer to about 13,900, or maybe just off 14,000. But I think this will probably have to be able to do that. And part of the reason why we've seen some tech weakness really was because of the rise in bond yields. And I'll talk about that in a little bit. But based on what we're seeing, the US market still seems to be quite solidly into an advance. There were 3 attempts for the S&P 500 to correct earlier on, and it did quite well in limiting that correction. How we wish we were in the same boat. But clearly the US is now encountering a lot of tailwinds that's supporting it. It has new stimulus. Last night we've just heard that the Fed chief saying that there may not really be a need to be able to increase interest rates yet, despite inflation climbing up, because they feel it's still under control. So they still have a relatively good environment in which the market seems to be recognizing, and why it's remained quite fluid into the upside so far. So unless this particular index managed to break below the shorter term moving average, so that's the 20 or 50-day I don't think we'll have any concerns from the US market as of yet unless something like that happens. The NASDAQ has the biggest risk to us, but so far the Dow and the S&P have managed to be able to hold their ground quite well. Now moving into US bond yields and commodities. Now, why am I talking about bond yields in the first place? Now, bond yields usually is looked upon as an advanced indicator for interest rates. So if bond yields start to be able to climb up, that means it's trying to anticipate that there may be a push for interest rates to climb higher. It may not be tomorrow, but it might be into the short term. And it's recognizing that need, perhaps because the US economy is recovering well. It could also be because inflation levels have also climbed up. We've seen commodity prices climb. The CRB index you see there on the right side is simply an index of all commodity baskets. It's heavily weighed on oil prices. And because of that, we've seen a relatively steep advance. As you can see in the chart here, from November till where we are today, we've seen a relatively strong advance. However, I do see some momentum weakness building in now, and I hope that we'll be able to offer up a little bit more of corrective time or a pause time in this advance that we're seeing in commodities, because we in the Philippines are also being plagued by higher levels of inflation, and it's also contributed because some of these commodity items have been relatively pricey in the world market, and some of which, of course, in the Philippine market in terms of things like pork. However, the conditions we're seeing here on the left side is the US bond yields, which has gone up since we last spoke. Last time I spoke to you, we were still somewhere over here, and that was roughly just off 1%. Right now, it's doing about 1.63%, and that's a very, very monumental increase since then. And a lot of markets got jarred because of that, including ours. And Philippine bond yields also managed to be able to climb up, as I'll show you also in a while. But I do hope that a lot of these aggressive movements in bond yields in the US seems to be tapering. I can see right now there are technical indications that the upward momentum is slowing. I can see divergent signals into the US 10-year, and that would mean that there's a high probability chance that this will either correct or at least consolidate for the meantime. And I think the market should take that positively if we can do that. But on the count that if it doesn't and it continues maybe a little bit more, that might be able to create more volatility for some of the weaker markets, not necessarily the US market. But it looks look quite confident we'll probably see that corrective move either sideways or reaction into bonds, and I hope that can really help us out. Now looking into the dollar and then of course the peso-dollar rate. Now, we've actually been seeing a very big spike. If you notice this movement here in the peso-dollar rate, part of that really is because we saw that the dollar index over here was actually getting stronger. More likely because since putting your assets into dollars right now is yielding a little bit better in potential returns as interest rates and bond yields go up, it probably would have made the dollar a little bit better. Plus the fact that, of course, the US recovery seems to be in better hand right now, especially with their vaccination campaigns being relatively solid. And of course, earnings seem to be also in the recovery streak as well. So these have proven to be very helpful for their currency. And of course, the Philippines has lost ground in terms of that in recent times. Last time I did present to you the potential of this devaluing situation occurring, and sure enough, it did. And now I think it probably would pause here first for a moment, maybe a little while longer. But after that, there could still be a potential for peso-dollar rate to weaken and maybe even go all the way up closer to a range of about 49.30, maybe even 49.80 if it's really weak. But I hope it's just going to be the first one. So it doesn't look like it's over as of yet, that there could still be more, but it proved helpful if the dollar were to stop climbing, because if the dollar stops climbing, at least that would be one leg off the pressure paddle here for the peso-dollar rate. Now, going back into the Philippine context, the Philippine 10-year bond yield also managed to surge up. Again, last time we were talking, we were still looking at the 10-year yield doing something closer to about maybe 3.1%. And all of a sudden, we just saw it surge up to about 4.55%. And roughly, that's because, of course, the threat of inflation has been relatively buoyant. And we saw inflation in the Philippines climb up between 4.2 to 4.7%. and that also contributed to the aggressiveness that we saw into the yields. Of course, also seeing what's happening to the yields in the US. So the tendency for markets is to try to acclimatize to one another and follow suit. I guess the only difference that we're looking up over here now is, so we're seeing inflation come in and interest rates come in, but is the recovery coming as fast as the way it is in the US? Because if not, then of course that will put us in much not so good light. The other thing also that you might want to have to take a look at now is if Philippine bond yields continue to remain relatively high or lifted like the way they are, it could press interest rates one day to follow suit. And just to be able to point out why that's a threat to the market and to what we're seeing some of the different type of instruments that may be, try to understand that if interest rates start to climb up, and right now we're still in an advanced indicator, so we haven't really seen a very pickup in interest rates as of yet, but bond yields, if they stay elevated, may eventually prod it up. So just to give you a sense of it, if your yields are yielding something like 4.5% and inflation is taking away from your money the value of about 4.7%, because that's what inflation does, it removes the ability for your returns to stay at the way they are. And let's compare that with the average return we've seen in the PSEi in the last 10 years, which is about 5.5%. In the last 20 years, about 7.6%. Now, I've also included the two REITs that we've had recently, which is, of course, the A-REITs. Right now, the yield's about closer to about 5.2%. And the DDMPR, which is potentially at 5.10% based on the IPO price that we were looking at. And so if you were to look at these yields you're getting on REITs and compare that to whatever the yields that bonds are giving you, which could be more safely endowed rather than their REITs, it doesn't really give you much spread. It's you might want to have to sacrifice maybe less than 1% for safety and for better guarantees of getting that return as compared to what you would get on the other side. So this could add pressure to these types of instruments, assuming that, of course, bond yields can stay elevated. So it is clearly in our benefit if things like if inflation and, of course, bond yields can eventually come down. And maybe let's hope that maybe April can shed some light later on the prospects of those. Now, of course, I guess the latest thing, and I believe this could be the reason why our index faltered in recent days, is really because of the resurgence in COVID cases. And of course, we've seen quite a bit of headlines. You can see the graph here on the left side showing and very much an increase in the daily cases of COVID. The 7-day moving average already tagging at about 4,400 daily. And of course, we've seen or read articles in the newspaper about hospitals getting filled up and very more difficult cases. And of course, it struggles because we've just gone 1 year off our lockdown, and here we have these things bothering us again. Now, we're not sure what is causing it. It could be new variants coming in. It could be the kind of the variants that of COVID that are currently here. It could also be that it's been 1 year. People are fed up from staying at home too much, and they are exploring the capacity to go out again and trying. Because, I mean, can you imagine what it's like to be able to stay cooped up for so long? And of course, the consequence of that is, of course, the cases that we're now seeing. Now, of course, we are quite hopeful that, of course, we see vaccinations starting to come into our country already. Although you can see here the chart on the right side, compared to other countries, Philippines, Thailand, and Vietnam are one of the lowest in terms of their ability to inoculate the population. Right now, we're doing only about 0.25% of our population that's even managed to be able to get a trace of that because of the difficulty in securing supply of the vaccination. So we really hope that this thing can speed itself up because it is taking its toll on our economy, and whatever that can help to try to ease that burden and open us up eventually is what we really need to be able to see in the short-term future. So what happened to the Philippine index? So the index fell down quite steeply about 3 days ago, and we saw that break the 6,600 zone. And to us, that was a critical support, as Marvin managed to preview earlier on. Now, to us, it was an important area because this is roughly where your 200-day exponential moving averages. It was also the site of the previous low that we scoped out here back late in January. And so a crack of this cracks this entire area pattern and now threatens a potential downward or at least an added downward action into our market. So what I've done is I've scoped up 3 zones for us to be very watchful of. First is 6440, which is a minor support zone. But to me, it is integral because this, if the index breaks below the 64 zone, would tell me that the market's intending to be able to react, with a bit more force. And given that context, a break of that would bring it down to a minimum of 6250. And I really hope that that area can hold because this is the site of where our channel is. And that area should be a good ground to try to be able to keep the market quite solidly higher. If it were to break the 6250 area, it's because of something that perhaps we've not seen yet that is coming into the picture and is proving to be quite disturbing into the safety conditions on what we have. And so we clearly have to be very watchful of those areas. Now, if somehow 6440 can hold and we can see the market turn up like the way we did earlier today, I mean, those are good signs that we can see the market attempt to make a resurgence. However, today's rally came in with not so good volume. 5 billion is really not enough to brag about. But what was nice to see is that we saw almost 3 times amount of advancers today than we did see decliners. But given that context, it's still not enough. Our market needs to go over 6,770 or 6,860 in order for us to get out of this corrective pull. If we don't, that would keep us under the corrective threat and allow us to, we may be able to rally, but it still have the ability for a market to be able to come down later on. Now, our market was near oversold conditions. Didn't tag it yet, but we were near it. Some issues are already at oversold capacity, so I hope that will help in crafting a bounce for us so that we can put in some sort of shelving here for support. But we just have to be able to understand that these conditions could be the start or could be a continuing aspect of a potential C wave, and usually C waves are usually as big as their A waves. So if you were to just measure the size of from where the A wave began from here to here and extend that from the B to the lower end, that's where this channel attempts to make an emphasis of where a potential support area can be. And to me, I would try to put a important line there. Anything lower than that to me wouldn't be acceptable. At 6.4, we have a good chance of still rebounding well. At 6.250, I'm kind of iffy already, but anything lower than that, that's telling us that the market is playing around with a very heavy force of selling that it will have to deal with. So going back into looking at where we are into the Elliott wave structure, looking at the bigger picture, I think we've completed the ABC swing as I pointed this out last time, and now we are in a temporary recovery mode here. So if we were to blow this up a little bit here on the right side, so I feel that the correction you're seeing today is part of a wave 4 type of swing. And that means usually after wave 4, there's still one more advancing wave that comes there. So I'm quite hopeful that we could still see a good viable rally after this correction finishes. And hence, this is the reason why we are talking about the opportunities in this correction, because this correction will put prices back down to that level that can generate more attractive look to you and offer you more upsides, at least into the short term, hopefully giving us back maybe to a range closer to between 6.8, hopefully higher, maybe closer to 7,150. If we're lucky, maybe even 7,400, which is the major resistance, as you see here into my chart into the right side. Now, in recent months, I've been actually watching over the German DAX to give us a sample of how we've been looking at. And our market has actually been following this sideways move, as you can see what we have here. But given what we just seen in recent days when the index fell below 6,600, this is the first time that a threat to that sideways consolidation model has actually taken form. And given that, I was hoping that we could see this type of correction into our market where you'd see like an ABC or a sideways type of correction and eventually twist itself into an advance. But now we've had to reckon that the first level of that low has been broken, and so that puts the first threat. A trend line here has actually been broken. Your 200-day EMA has been broken. This is the reason why we'd said earlier at 6,600 was a very crucial support area. And we need to be able to jump above that area, or at least recover back above 6.6. We cannot stay below that area too long, or too many people will get caught and eventually will cause the market to implode. So we really need to be able to generate that rebound as fast as we can. So what I'm showing you over here is that this is now making a little bit lower low than the previous A. In the DAX model, we didn't do that. And so this is why I'm a little worried that we could be pulling out of that scenario. But like I said, if somehow a miracle rally can come out of this, we can still save the day if such a thing takes place. Now, last time I also aired out this view and my argument to why I feel that the market should take a more consolidating type of correction stance now rather than a reactive stance. I will show it again so that you can basically see what my ideas are. So normally when markets correct, they do so every alternating fashion. So if, for example, the first correction you see here was a very sharp decline, the next correction is usually sideways or a consolidation. And then after that, the next correction, again, is a very wide decline, again, another strong reaction. So the next one should also be a more acclimatized or much more consolidating one in fashion. So I've outlined those two areas between 6,400 and 6,250 with this blue and red arrows. And these are the important thresholds that our index cannot afford to break. So as long as we hold above these areas and we can see this index recover back, we still have a chance to be able to see this type of a corrective move and not one that will cast us all the way back down. But of course, a break of 6,250, all bets are off. We'll probably have to be able to recalibrate our efforts because the market may be detecting something much more heavier in pressure that we'll have to be able to take a good measure of. Okay, so looking to the subsectors into the Philippines, I cannot say that it looks very nice because right now, last time I spoke to you, I had all these in blue. That means they were still kind of consolidating in nature. But if you were to look at now, the services index are now into a reactive trend. The property index now entered a reactive trend. Of course, the holdings also into a reactive trend, as is the commercial industrials also in a reactive trend. So based on all our sectors here, 4 out of the 6 that I plotted out here are actually in reactive trends. So it's only because some of the bigger issues that have to be holding is the reason why your index is still kind of in a sideways track. And this is also another reason why we have to play a very, very watchful game and a very selective game here, because not all issues will just rebound in the same way. There will be stocks that might rebound better, and some might be still clearly depressed into a rally, maybe just at best a rally a little bit and generate a sideways movement. So here you really have to be a good stock picker to be able to know how to be able to tell the difference, whether one can rally more or whether those that will probably have a very blunt type of rally. So I would not suggest that you'd buy this market broadly, but you have to be a bit more selective and being a good stock picker to be able to fan out into those opportunities that you will be getting. Now, I put first all the index stocks here, and anyway, we'll discuss a lot of the smaller issues, I think, because I noticed that some of the stocks many of you guys requested for were more of the non-index types. But based on the index types of issues, because these have more weight obviously into our index, I just wanted to point out a few facts. Right now, I only see 3 of them showing very strong trends, and that is Emperador, First Gen, and ICT. I mean, in terms of the rest, these are the kind of strongest ones that we've had so far. So that's 3 out of 30, which is a very, very small number. However, I do see about 12 of them, all these I've outlined in blue, that have good capacities to be able to make an interim recovery. So if some of you are trying to be able to buy either an oversold bounce or a technical bounce that can climb back to next resistance, the ones I've highlighted in blue might be some of the issues that you also might have a look at. And given those particular things, 22 of these stocks are still in weakening trends. They may rally, but they're still in a weak trend. And that means that's more than 2/3 of the market. So that means that we have to approach this market with a good sense of concern and defensiveness. Like I said, you cannot be broad-based when you buy right now. You have to be very specific. Look for issues that are doing things that are outperforming or showing you a better capacity to hold rather than just topple over. To give you an example, for example, if you look at Aboitiz Equity Ventures, I mean, the other day it fell down very, very strongly. So clearly there's something very weak about that particular market that we have to be very careful about. Also recently, in the last 2 months or so, we've seen very weak movements in issues like Pure Gold, Robinson's Retail, but it's one favorable thing to see is maybe Pure Gold is closer to being oversold, so hopefully there can generate a rally there. And Robinson's Retail showing some degree of technical recovery, but still not out of the woods just of yet. So we have to be very careful about this market right now. Look at some of the issues that I proposed as a potential rally. And remember, when I say this is a potential rally, a rally is a temporary recovery, right? This is not an uptrend as of yet. So if we can rally from here, take what you can, wait for the next reaction for us to be able to look for potential entry spot. So the PSE recent support of 6.6 presses on quite a bit of technical concern to me. And we have to be very watchful of our next level of support. There's 6,400 being a minor support and 6,250 being a major support. However, I would like to see 6.4 hold, because if we can see the market hold above 6.4 and recover, then that means the consolidating type of correction is still intact, and we can still rely on the DAX model to keep us going and eventually seeing a much more formidable advance into the market. Now, if we go into a deeper reaction and we do hit the 6,250 and that engages a full length C wave, I think after that, you'll probably see a nice recovery anyway. And that might be an area that you also may be able to put in an entry spot for some of the stocks that we talked about. Now, the US market doesn't seem to be of a concern as of right now. I'll only be concerned, like I said earlier, if I see the 20 or 50-day EMA start to break, but right now they're far from that. So far so good, and they seem to be relatively buoyant and encouraging other markets to be able to climb as well. Furthermore, the US bonds, as I pointed out earlier, look short-term topish type of signals, and I hope that that can actually flatten or not go down, because a pullback into bond yields, I think, could help many markets try to be able to stagger back, so to speak, rather than the weakness we've been seeing of the threat of inflation and interest rates. And of course, the end of a C wave, in case we do see the 6,250 area. I know it may look scary to you, but remember, we've fallen down a little bit already, and it will engender an oversold condition in the market, and that itself will push the market up into a recovery streak. That might give you a short-term opportunity. And right now, while we are in a corrective environment, we have to take the market with whatever opportunities we can. Later on, when the 50-day or the 20-day moving average of our index is broken at the top side, that will engender a better buying opportunity for you. And that should be able to allow you to be much more broad in your ability to pick our market. And I'm almost sure that maybe about 20 or 25 of the index stocks alone should be able to lead up to good rallies if that particular phenomenon comes in. Plus, of course, you've got secondary and tertiary stocks, which may also follow suit. As you can see, our recent activity in the market has been concentrating on non-index stocks, and I'm sure that you'll see probably a likes of some of these things try to make recoveries as well. But later, let's just make sure you understand that some of these smaller speculative stocks are a bit dangerous. So you have to know what you're getting into, especially when you're attempting to be able to trade these kinds of issues. So know what your risks are when you come and deal with these particular stocks. I hope that everybody can actually be more clear that I'm a bit more defensive right now because of the support break, although I'm a little hopeful that the support areas can hold, and I hope that they do, so they can provide us an interim rally opportunity that many of us traders can take advantage of. So with that, thank you very much.